Hi, this is Stephen Ertel with Concinnus Financial. Thanks for joining me for this presentation on margin debt, the trailing leading indicator of U.S. markets. This will be more of a high-level overview of margin debt with a brief explanation on what margin debt is for those who might not know. So let's go ahead and get started. First, what is margin debt? Well, margin is essentially when an investor borrows from a stockbroker to purchase the desired investment. So for the sake of simplicity, we'll just use stocks here, where those stocks that the investor purchases on credit serve as the collateral. The broker essentially takes no risk, but they do earn a certain rate of interest on the credit that they extend to the investor. So I have an example here. Must Be Greedy is an investor and she thinks that Apple stock is really going to do well for her. Now she only has $10,000 in cash to invest, but thankfully or unthankfully, her broker Short-Sighted Capital will extend to her a $10,000 line of credit to purchase Apple stock with. So at this point, she's sitting at $20,000 in Apple stock. She's leveraged 2 to 1, or we'd say sitting at 50% margin. Now, if Apple were to gain 10%, then Greedy has actually earned a 20% return on that $10,000 in cash she initially invested. In the same way, if Apple were to decline 10%, Greedy would actually incur a 20% loss. Now, all is well for Greedy as long as Apple stock increases in value. So what happens if the investment loses value? Well, the investor might be hit with a margin call, which is essentially when, due to losses in the account, your broker demands that additional cash be deposited into the account, or they will sell some or all of your stock to bring your account back into line with their maintenance margin requirements. Now, for the sake of simplicity, I'll use a 50% maintenance margin level in this example. We'll catch back up with Greedy, who unfortunately has taken a 25% hit on her Apple stock. So her account value from $20,000 down to $15,000. Short-Sighted Capital immediately requires her to deposit an additional $2,500 into the account, but since she is short on cash, Short-Sighted goes ahead and sells a third of her stock to bring the account back to that 50% margin level. Notice that Greedy has incurred the full $5,000 of the loss of her account. So from $10,000 of her own cash down to $5,000, because Short-Sighted had to sell a third of her shares. That took the total account value from $15,000 down to $10,000. So just to recap, Greedy, $5,000 in cash, $10,000 total account value, is still levered 2 to 1 or 50% margin, but she's taken a 50% loss on her Apple stock and now holds a third less shares than she started with. So is trading on margin investment or speculation? As I referenced earlier, leverage serves not only to magnify returns, but also losses. And I'll draw a conclusion here that increased levels of margin debt can both spur an impressive increase in market prices, or as prices begin to decline, forced selling in margin accounts can accelerate that decline in prices. And I'll use the spectacular meltdown in Chinese equity markets this summer as an example of this. Prior to peaking this summer, the Shanghai Composite increased in value by about 150% in only 12 months, likely due to aggressive and unrestricted buying in margin accounts by Chinese investors, or shall we say speculators. However, after prices began to nose over this summer, aggressive selling in those same margin accounts likely fueled an impressive collapse in equity prices, leading to a 40% decline in the index in only 3 months. Now let's move to margin debt in the US markets. In this chart here, I have the blue line representing the level of the S&P 500 that uses the axis on the right. S&P currently sitting at about 2075. And the axis on the left shows the level of margin debt in millions of dollars. So these numbers are billions. Current margin debt is indicated by the orange line, sits at $472 billion as of the end of November. What I'd like to point out here is just the overall positive correlation between margin debt and the S&P 500. As margin debt increases, so does the S&P 500, but as margin debt decreases, so does the S&P 500. What I think is more telling is to look at the percentage change in margin debt in the S&P 500 during that same 30-year period. Ignore the green dots in the right-hand axis for now. The blue line representing the S&P 500 illustrates that the S&P has returned in excess of 1,000% over the last 30 years, ex-dividend, which I think is pretty impressive. But more impressive is that margin debt has ballooned by over 2,000% during the same period. As we saw in the last chart, we have the same positive correlation between the margin debt and S&P growth rates. What I really like to highlight is the divergence in growth rate from 1999 through the present. Or in other words, it's taken increasingly large amounts of margin debt to fuel increased levels in the S&P 500. In fact, since 1999, the S&P 500 has returned about 55%, with margin debt growing by 175% during that period, so 3 times the growth rate in margin debt. If we compare that to the 1985 through 1999 period, margin debt in S&P 500 had essentially the same growth rate. I would postulate that low prevailing short-term interest rates have really fueled the growth in margin debt, or in other words, it's cheaper for investors, or maybe more appropriately speculators, it's cheaper for them to use margin to magnify those returns. If we look at the green dots, these represent the ratio of margin debt to US GDP. From 1985 through the mid-90s, margin debt was about 0.5 to 0.75% of GDP. However, corresponding with market peaks in 2000, 2007, and potentially even today, we see margin debt relative to GDP peaking 2.5% in the year 2000, 2.7% in 2007, and earlier this year, corresponding with the all-time record high for the S&P 500, margin debt peaked at 2.9% of GDP. Now, takeaways from this presentation. It would appear that at some point there's a peak in margin debt levels where investors or speculators lose the appetite for more margin debt, or due to decrease in stock prices, everyone kind of runs for the exits. Now, it would appear that changes in margin debt actually precede changes in the level of the S&P 500, and that would be correct. So that's why I kind of refer to margin debt as a leading indicator of the S&P 500. However, as you see in the title of this presentation, it turns out to be a trailing leading indicator because the data is delayed 1 month from NYSE. So November's margin debt numbers just came out Christmas time last week. However, we can still look at the overall trends in margin debt to kind of look at trends in the S&P 500. So from levels today, for a continued bull market, I would be looking to see margin debt levels exceed the $510 billion that we saw in June of this year. Without margin debt increasing from levels now, I would look at the S&P 500 to be trading sideways. Or if we saw a large decrease in margin debt, I'd be looking at a correspondingly large decrease in the level of the S&P 500, or which could perhaps indicate a protracted bear market. I'll wrap up the presentation there. Once again, this is a more high-level overview of margin debt. For more detailed analysis, more data, and more charts, tune in for my next presentation, Margin Debt 2.0. I'll be gearing that more towards finance professionals, and it'll be a little bit more difficult to follow for everyday folks. Following that, I'll offer a more contrarian perspective on crude oil, and on January 13th, Concinnus Financial is hosting our 2016 Economic Outlook. For those local here in Spokane, that'll be downtown at Nectar Wine Bar, January 13th at 6 p.m. We'd love to have you out for that. For those who aren't local, I'll be posting the presentation online in a similar format. Once again, thanks a lot for watching. My name is Stephen Ertel. I'm an investment advisor with Concinnus Financial. We're fee-only investment advisors here in Spokane, Washington. We really appreciate you watching our videos, appreciate you subscribing to our channel. Everyone have a happy new year. We'll see you in 2016. Thanks.